All right, hello everyone. Welcome to our first event, the accounting design project this fall. My name is Wei Cai. I'm from Columbia. First, I'd like to thank both Anya and Stephen for organizing this great session. And also, please allow me to welcome today's speaker, Professor Bob Resutek from University of Georgia. He's going to present this very interesting paper, the effect of accrual heterogeneity of accrual quality inferences. Just a little words, a few words on the format. Please give the presenter maybe a few minutes uninterrupted time. And then after that, we welcome any comments or questions. And then please use the raise hand function. And then once there's a question, then I will help the presenter to moderate these comments. All right, thank you very much. And I very much look forward to the presentation. Okay, Bob, the floor is all yours.
Okay, thank you, Wei, and thank you, Stephen and Young for putting this together. I agree, this ADP project and being able to present online, I mean, it seems like, I mean, as bad as COVID's been, as many costs as we've incurred, like this seems to be one of the benefits in terms of being able to share our work with people around the world in real time, almost like maybe similar to what SSRN did 25 years ago. So thank you for putting this together, and thank you for inviting this paper. So this paper sort of came out of a idea, you know, sort of like a lot of my ideas. I think it's, you know, I was dealing with a referee on another paper and trying to figure out how to address certain comments. Chad and I were working on a paper at the time, and so we sort of put our minds together and started thinking about, you know, is this something we could do? This data seems important, and you know, so then we started researching it. Chad got into the coding, and this is stuff I'll talk about. We brought Patty on, and so over the last couple of years, the paper has come together. The version you're looking at is sort of the most recent version, and so I'm interested in your comments. So sort of what do we do? Sort of this general question. You know, one thing I think all of us have ever come across, especially as we teach FSA to MBAs, and maybe we speak to finance majors, those that aren't pure accountants, is, you know, we talk about this idea that accruals are heterogeneous. You know, we've got, and this is what we're excited about as accountants, you know, we've got income statement centered accruals, bad debt expense, stock-based compensation, debt premium amortization. Some of these have a lot of discretion in them. Some of them have very little. We've got these balance sheet centered accruals that have become increasingly more important. You know, you have things like different types of asset impairments, triggering events, all these different rules that we follow. These are very different than, you know, bad debt expense and stock-based compensation, albeit there's still discretion in there. And now we've got this, we also have this increasing prevalence of fair value accruals, which, you know, there's almost no discretion, at least reporting discretion on what we put in there. So we teach this to our students over 5, 6, 7 financial accounting classes, you know, so that they can be prepared to go into industry and practice accounting. How do we research it though? We basically just say accruals are homogeneous, you know, and, you know, accruals roughly equal net income minus cash flow from operations, or you could use change in working capital from the statement of cash flow as they do in Deshao and Dechev. Maybe we can just use change in working capital from the balance sheet with depreciation subtracted without it. And, you know, we read and review these papers, and there's often a footnote in there that says like, look, in untabulated analysis, we replicate our primary work and with alternative accrual definitions, and our primary results hold. You know, everything's quantitatively and qualitatively very similar. You know, and so to which, you know, it kind of begs the question, like, why do we have all these rules, all this different accrual heterogeneity that we teach, and then we have this very generic course definition of accruals that we use in research? And so kind of this accounting design project, this ADP goal that we have with this paper is, you know, can we flesh out the accruals that we teach our students when they go into practice? Can we bring that into accrual research? Because we think there's a lot of interesting dynamics here that we don't have access to. Okay, and why don't we have access to this stuff? Well, I mean, CompuStat. CompuStat's this great data source that's been around, I don't know, 30, 40 years. I'm not exactly sure, but it's really kind of, it really pushed financial accounting and finance research forward. You know, it's a database of financial items. And I think what's important to appreciate, and perhaps I didn't appreciate it as much when I was a PhD student as maybe I do now, is CompuStat variables are a function of the financial statements. They are not the financial statement items. Okay, and so certain items that we see in CompuStat, you know, if we go back to, you know, the old ones, you know, old people like me remember, you know, data 6, data 1. Data 6 was total assets. You know, total assets in CompuStat equals total assets on the balance sheet. Sales on the income statement equals sales in CompuStat. But many items are not. You know, if you think of what CompuStat needs to do, it's got tens of thousands of different line items across thousands of firms every year, to which it needs to funnel these items into maybe 60, 70 different data items. Okay, so it needs to make decisions. And you know, one example would just be cost of goods sold. Cost of goods sold on CompuStat is defined as basically cost of goods sold on the income statement less depreciation from the statement of cash flow. Okay, and this is so that CompuStat can make depreciation a separate line item in the income statement, a separate income statement line item. Okay, and there's other examples out there, but it's something important to understand, is that the financial statement items that we use in our accounting research do not map dollar for dollar to what's actually on the financial statements. Okay, so what are the disadvantages to this? Well, especially for accruals and for other items, CompuStat, because of how it needs to standardize the data, is going to aggregate a lot of manager reporting choice variation into these catch-all variables. You know, and this happens both cross-sectionally and in time series. You know, in the beginning of the paper, we flesh out, you know, we write about how, you know, there's all these different accounting rules that just get lumped into this variable, this catch-all variable. There's that, and these rules, these different accounting rules, haven't been static across the 30, 40 years that we've been doing accounting research, but they, you know, every now and then the FASB puts another rule in, to which the cross-sectional variation of these variables are going to change. And so, you know, we've got these, you know, because of the way CompuStat aggregates variables, we have these shortcomings in the data we're looking at. And so, you know, this ADP project importance, sort of like how we think our paper helps, is that for accrual research to advance, and Chad, Patty, and I like this area. You know, we've written a couple papers in the area. For it to go forward, we believe we need more precise data. You know, we've got all these different accrual rules, conditional conservatism, matching, fair value, you know, these that have different principles behind them that we can't test precisely. We can't really get at given just CompuStat data. All right, so what do we do? You know, so we look at the statement of cash flow, which seems like a weird place to look for accrual data, but I think this is an important area to start. So we know from as accountants, CFO equals net income minus change in working capital minus what we call non-transaction accruals. And so I'll get into exactly what these things are, but what we're trying to get at is this, you know, as researchers, and then in this paper, the accrual component of earnings. Okay, and so as researchers, we've kind of broken this into two parts. You know, and by researchers, I mean this, you know, collectively, the royal us. We've got working capital accruals, and one thing I want to point these things out, and please don't jump down my throat. These are generalizations that I'm going to throw out there. I think they're roughly true, but they're not absolutely true in every setting. These working capital accruals, you know, these are primarily driven by arm's length transactions. You know, there's a high, or if you will, higher degree of verifiability. You know, there's this indirect effect on earnings. I think, you know, Steve Penman spoke about this a couple months ago on this very channel for a paper he has. These working capital accruals do not directly affect earnings. And then we have what we call non-transaction accruals, and these are sort of these adjustments, these accrual adjustments that come between net income and the working capital adjustments. Okay, and so these are driven, these are things like depreciation, write-downs, bad debt expense. These are driven primarily by managers' estimates of changes in the capitalized value of assets and liabilities. Okay, so this is sort of where we think, again, the royal we as researchers, this is where reporting discretion comes into play. Okay, this is managers at the end of the fiscal period saying, all right, what do we think? How much should we accrue for bad debt expense? Should we impair inventory? Has a triggering event occurred? And if so, how much should we impair assets? These not only are they driven primarily by manager discretion, reporting discretion, these do have a dollar for dollar effect on earnings. This is sort of what we're interested in. So why don't we test this? The way CompuStat lays this out, and I'm sure this is just a function of sort of the way they built up over time. Non-transaction accruals, there's basically 4 to 5 items, depending upon how you want to think about it. You've got your depreciation and amortization. Then you have your earnings from unconsolidated subs, deferred taxes, gain and loss from sale of PP&E. Those are pretty straightforward. And then we have the item that we're interested in, which is sort of the catch-all, funds from operation other. So what this item is, this is basically any sort of reconciling item that doesn't fit neatly into the other 3 or 4 categories. So what CompuStat's going to do is like, I don't know where to put this. Boom, let's put it into FFO. Okay, and so this was an idea. This was something that I came into. I wasn't aware of it. John Llewellyn and I were working on a piece that's in RAST, and this was one of the things we needed to do was sort of look at what's contained in this FFO, and that's sort of what led me down this path for this project. But you know, this is where all this, when firms report bad debt expense, inventory provisions, asset impairments, asset retirement obligations, pension adjustments, stock-based compensation, all the cool stuff that we teach our accounting students over 3, 4, 5, 6 classes is sort of lumped into there. Not always, but often is the case. And so what we want to do, sort of like our contribution, at least as it relates to kind of this ADP framework, is what is in this data item? And can we map this out, you know, by firm, by year, by measurement rule? Okay, and if we can do so, you know, what sort of, do we change inferences? Is this, we hope this is going to help our accrual research, our accounting research. All right, so just a couple of examples. These are just motivating examples. There's nothing special about these. I didn't spend much time trying to find the perfect example. The next 2 examples I give, it's just basically, the only screen I put in there is I want a non-microcap stock. So these are all firms that the market cap is, you know, above the 20th NICE percentile. So this is a company called Kforce. I don't even remember what they do anymore. But in 2010, they had just, they beat their earnings expectation by 1 cent. Okay, so we're all aware of that sort of, you know, thinking about reporting discretion and how it affects earnings firms report. So here's what their statement of cash flow looks like in their 2010 10K. All right, so again, net income up top. Then we have all these reconciling items. So all these F's in red, hopefully it comes through on the slides. These are the line items that factor into funds from operation other. Okay, and so I think it's interesting, Chad and I and Patty think it's interesting along a couple dimensions. And so I just want to flesh out a couple of these items. So you have things like goodwill. You know, this has a certain accounting rule to it. It's relatively persistent, but it's completely discretionary in terms of what managers, how they're going to impair their goodwill. And you notice it applies for 2 of the 3 years. There's recovery and provision for bad debt expense, there's stock-based comp, pensions. There's all this sort of, I don't want to say accounting minutia, but these different line items. And if you know anything about accounting, you know that there's different rules that are applied to come up with these numbers. Second thing I want to point out, notice how there's positive and negative values here. And I think this is something that we lose, that we don't see as archivalist. You know, we have a recovery of almost $3 billion for bad debt expense in 2010. And there was a bad debt write-off or provision for bad debt expense of 5.3 billion in 2008. Pensions and post-retirement benefit expense. These are add backs. These contrast the gains and the recoveries that are negatives or reductions in the reconciliation in 2010. And then also notice how items come and go. Okay, so in 2010, the goodwill and intangible asset impairment, it wasn't an item. They did not have one of these reconciling item in 2010. They did in 2009, 2010. So it's not like the composition. And again, if you look at other firms, you know that this holds. Every firm is not going to recognize the exact same line items every single year. So there's not really a firm or a manager fixed effect that you can just say, well, I control for this heterogeneity using the firm fixed effect, because this stuff varies over time. Okay, and so these are sort of the line items that we see. Here's another one, Resolute Forest Products. Again, I'd imagine they must be some sort of timber company. Maybe they make paper. But again, there's many different items that factor into FOPO that as researchers we have largely ignored because we don't have access to this data from CompuStat. It's just some of the line items we do. Share-based compensation is a line item within CompuStat, but many of these we don't. Gains on the forgiveness of a note payable. We don't know if that was going to occur. We don't have any item on that. Write down of equity method of investment. We don't have anything on that. Closure costs, impairment, and other related charges. This is sort of interesting, right? Because I think often in workshop, we think of these things as sort of one-off transitory items, but we see for Resolute Forest Products, at least over this 3-year span, they recognize an impairment or closure related costs in each of those 3 years. So this sort of, does this hold for every firm? I don't know, but I think in general, the general view of these items is these should be transitory. So this is sort of what we flesh out in this paper.
Hi, Bob. So you have a question from?
Yes, go ahead, Wei. Or whoever has the question.
Hi, Bob. This is Ayong. Yeah. So this data set is fascinating, right? As an archival researcher, it's like finally somebody gave us those detailed line 32 precisely line items. One question that came to my mind is that how many of those statement of cash flow line items can be kind of inferred from changes in balance sheet line items in CompuStat? So for example, there's a deferred revenue adjustments. I know not a lot of firms, I think there are only probably 61, 62 observations, but we probably can use changes in the ending balance and beginning balance of the deferred revenue reported in the CompuStat balance sheet to kind of infer what's the adjustment. Because statement of cash flow has a flow, but we can use the changes between the beginning and ending balance in the balance sheet to actually infer the same number. So
yeah, good question. And so 2 thoughts on that. Because like share-based compensation, stock-based compensation, that's obviously now a line item within CompuStat. It wasn't always, it is now. And I think that's one that generally maps dollar for dollar. One item, I mean, I thought you were going to go this route, is like, how many of these are special items? Like these are things that CompuStat pulls out. And I can speak to that. And I would say that we looked at this. We used to have a much longer analysis that we've removed from the paper because we thought people would be interested in it, but it never really came up in the review process. But it was, if we removed all the special items from FOPO, how does that adjusted FOPO number correlate with the unadjusted FOPO? And the correlation was quite high, meaning that many of these items, while some of them are special items, many of them, it's not like you can just say, well, these 3 items in FOPO are already called out in CompuStat under special items. Like, I can't remember if it's Resolute or if it's Kforce, but there's these firms, one of them at least has a special item in CompuStat for each of the 3 years from their statement of cash flow. I could not, from looking at the statement of cash flow and looking at the special item in CompuStat, come up with how they got that special item number. And we know that from prior research that special items are something that CompuStat comes up with that don't necessarily correspond directly to what's on the financial statement. So as it relates to whether I could do deferred taxes with changes in the balance sheet, we haven't looked at that question, exactly. I'm sure some of this stuff for some firms, you could flesh this out. I think what we like about this though, is that these are, this maps directly into our statement of cash flow. So we don't need to make these one-off adjustments. We can just say, look, this is what the firm reports. This is sort of the different measurement rules that apply for these. And we can tie that into our general accrual framework. So I don't think for most of these items that you can get them from other CompuStat items, other than maybe, share-based compensation, I think would be the exception.
So I have a follow-up question. Is that what do you view this paper as a kind of like the message you want to give to the future archival researchers try to document or infer earnings quality or accrual quality? Like, what do you want us to do? Like, take advantage of a disaggregated data set or use your methodology in Appendix 1? Like what?
So a couple thoughts on that. And ultimately it's your decision as a researcher. I know Chad and I and Patty think the data is really cool. And I think all of us have sat in research workshops and reviewed papers where it has something to do with reporting discretion, managers doing this, our measures of earnings management are quite coarse. They were great in the beginning when they came out in the 90s. It gave us some way to kind of think about these questions. But over time, we've fleshed out, like, we're skeptical that these measures are really capturing discretion as we think they are. And so maybe the thing Chad and Patty and I think are I don't say most proud of, but the thing we think is most interesting is sort of this data and sort of this ability. And I think you and I were speaking offline beforehand, this idea, like when you look at the full section of firms, only roughly 18 a year report warranty expense as a reconciling item on the statement of cash flow. So to the extent, someone, 10 years ago, 5 years ago, someone might say, look, managers are managing all these different type of accruals at once, and you've got to think about warranties. And we had no way to think about warranties as archivalists. Now we do, and now we can say it doesn't seem to be that big of a deal. Even AR, the cross-sectional volatility on that is relatively small. So we can kind of think about that. So I hope the data is sort of we can start incorporating this into our existing research designs and kind of blend it seamlessly with the other CompuStat variables.
Thank you.
Yeah.
All right. Thanks, Ayang, for the question. So next one, Somnath.
This is Somnath here. I'll sort of caveat my question with the notion that, I haven't really had a chance to read the paper completely. So.
Oh, Somnath, I think you're on mute.
Sorry, am I good? Yeah. I want to caveat my question by saying that, I have not had a chance to read the paper carefully. So I may be going completely off on a tangent. But the thought that occurs to me is to what extent will at least some of these issues sort of go away or arise due to the lack of or sort of, presence of articulation, if it is well articulated, or is this at all not going to be affected by the extent to which these statements are articulated or not?
I'm not sure I'm following. So are you saying?
So there are papers that have documented that yes, some of these CompuStat items are not well articulated, right? Mike Kirschneider and others. There are I think one in RAS and another in the Financial Reporting Journal, where they talk about articulation of the financial statements.
Okay.
And I was thinking that to some extent, some of these issues may sort of be resolved if we understand the extent to which these CompuStat items are articulated or not.
It could be, and I haven't really given that much thought. so that might be something that future research can look into. Yeah, I think there are differences, as you know, like you alluded to Michael's paper on the articulation differences when if I remember right, differences between inferences off of balance sheet accruals versus statement of cash flow accruals. That I don't think we really speak to. Where I think part of what we're getting at is maybe this will give people more accurate ammunition to fire at questions like that than what we've been using.
All right, thanks, Somnath. Next questions from Stephen.
Yeah. In answer to Young's question, I think what you're saying is that we've been a slave to CompuStat, and that's been we've been lazy. If you want to understand this information's available, you want to understand how the investor see or a diligent investor sees, there's footnotes, the warranty expense, you go to Schedule 11 and so on. Okay, and that to actually do our research, because of those complications with CompuStat, the cost of goods sold number is amazing in CompuStat, that we need to be more diligent. And we're doing a lot of this, I'm not doing it, but a lot of people are doing this text analysis in the footnotes and so on. That should be the basis of our data rather than CompuStat. Would you agree with that?
Yeah, I agree. I mean, the only thing I would say is I don't know if we've been lazy. I mean, as much as like the technology hasn't existed for us to be able to do this efficiently. And, you know, like Chad had 4 computers set up in parallel to kind of flesh this stuff out in his office. So, I mean, like 10 years ago, I don't know how this would have been done efficiently. Whereas now I think with Python and other coding technologies, it's much more, it can be done much more easily.
Yeah, fair enough.
All right, thanks, Stephen. Next question is from John.
Hi, Bob. Good
Yes.
to, so to speak. What's the status on the availability of your and Chad and Patty's data?
So Chad, I just spoke with him this morning. He's not on the call because he's traveling to BYU. He said it's close. A lot of this is sort of cleaning it up. My understanding, and then making sure we're not exactly sure what we're allowed to release, like in terms of linking it up with a CompuStat data. Like, can we use GVKey and FE, or do we have to come up with some other matching criteria? So it's essentially ready to go, hopefully soon, but I'm going to say that's not my baby to deal with, but I've been assured that it's close. And at the very least, the data that we have that we use in this paper should be available very shortly.
Okay, thank you. And I only raise that because I think that what you 3 have done here is an amazing gift to accounting research. And I just want to publicly commend you for taking all this time and effort and then, you know, not hanging on to the data for 10 years, because I think the more we can gift to each other in terms of these kind of extraordinary data sets, the better off we'll be. So thank you very much.
No, I appreciate it. And in the spirit of 80, go ahead. Sorry.
One other thing. So I think you said, this is a little sidebar. I think you said that, gosh, maybe CompuStat research been around for 30 years. So at the age of 61, I have a rule, which is I think of a number and I double it. It's actually been around since 1962, CompuStat. So
okay,
all here seems to have worked out fairly well. So thank you.
Yeah, I mean, in terms of this data, I do want to throw this out so I don't forget. There are, if there's any, you know, ambitious PhDs out there, is you'll notice in our table 1, there's certain items we haven't reconciled everything, and Chad is working with someone to try to make sure, to the extent we can get every single firm's FOPL item reconciled. So if there's anyone out there that's really good at Python and is interested in it, I'd encourage you to contact Chad, because ultimately, I mean, we will post all the data we use, but it's not a complete set that maps firm for every single firm within CompuStat. There's certain items that are more difficult. So in the spirit of the ADP that we give and take from each other, we'd love it if you're ambitious enough, if you want to help us with that would be great. Okay, any other questions?
No more hands.
All right. So what do we do? Or kind of like our results summary. So as I've alluded to, we've got this new data set. I think we've got 21 years, roughly 68,000 firms. You know, and all this stuff ties directly into the CompuStat variables. All right, so just to sort of maybe distinguish this study from from other work that, other accrual decompositions. If we think of, Richardson, Sloan, Solomon, Tuna, 05, 06. I think, Llewellyn, I've got a paper with John Llewellyn. There's many different papers that decompose accruals. Well, these decompositions are based upon CompuStat variables, where you combine different CompuStat variables to come up with a different accrual definition. We go the other way. We take a CompuStat variable, accrual variable, and we break it down into 32 parts. And as you'll see, and you can imagine, there's some judgment that goes in there, but we tried to keep this as objective as possible in its formula, and the way the data is driven off the coding, it can be replicated going forward. And so what we find and what we'll see is there's significant variation in the gap measurement rules. So the way the paper reads, we have to find, because of the way academic accounting works, you need to test something, right? So we formalize our test with the earnings persistence regression. And we allude to this, or we speak to this as sort of speaking to earnings quality, but I think a lot of the different earnings quality characteristics, whether it be smoothness, discretionary accruals, quality, can be modeled via these persistence regressions. And so this is how we set up our tests. And sort of one of the things I think we find is, not surprisingly, the reason accruals are less persistent than cash flow, some of this has to do with, it's just the way the accruals are set up. It's not that surprising, like fair value accruals should be IID. There should be no predictive power for fair value accruals. And what do you know? That's what we find. But I think there's some other interesting items in there. We set up a model. We build a simple little model that extends some other measurement error models, just to kind of show, like, look, some of these items you might think are correlated with where estimation error, manager manipulation may occur. So we do a little bit of linear algebra and kind of set up an empirical test to say, if you were to think this, this is how big if estimation error was this large, this is the effect it would have on the accrual slope. All right, so this sort of speaks to, Ray Ball's comment, from a paper years ago. It says, like, it seems like our earnings quality measures and our earnings management measures are too large. It doesn't make sense for that much manipulation to go on. And so we sort of set up a formal test. The last thing we do, which I think is interesting along several dimensions, is we just look at sort of like, there's the consistency in which a firm reports a line item. Does this matter? Can this help us? And I think there's some cool ways this helps us flesh things out. And in the interest of time, just a simple example of this, and we write this up in the paper. Let's say there's a firm that looks at its inventory every year and says, all right, we are going to recognize a provision for this obsolete inventory. And they do this every year. And they call this inventory provision. Let's say there's another firm, firm B, that looks at their inventory and says, there's this big chunk of inventory that's obsolete. We're going to write it down. So they do that once. Okay. If you were just to classify, both of these as inventory provisions, because they're both labeled the same way, you are going to miss the intent of the managerial intent of these accruals. The one-off nature of firm B, that's more of an impairment. We wouldn't expect that to be very persistent, as opposed to firm A that recognizes a provision each year. And so part of what this reporting consistency allows us to do, this measure we come up with because of the data we collect, we can flesh out sort of this, for lack of a better term, we call it managerial intent. What's the intent behind the accruals these managers report? Because as you can imagine, something could be called inventory provision for two firms, but they follow two different accounting principles. One's more of a write down, whereas one's more of a kind of a matching type accrual. Okay, so this is sort of something that we provide some evidence on. All right, data sources. The only thing I'm fleshing out here is we try to get everything. All right, as you'll see in table 1, we haven't quite gotten there yet. We don't anticipate there's any sort of systematic bias that injects in our work, but basically it's like if CompuStat has it, we look at it. Okay, and so this is from 1995 till May of 2017. All right, data sources.
Bob,
yes.
Ayala has another question for you.
Yes, go ahead.
Hi, Bob. My question relates to your previous slide about what you do in addition to the persistency test. You have this measurement error model, kind of like related to your paper
Yes.
with Jonathan, and then this consistency. I think that is, my question is more related to writing, because I feel like right now your paper create this new disaggregated line items from statement of cash flow, but all those new line items are still reporting numbers as a function of the following things you mentioned in the paper. Can be economic business activities, can be pure measurement errors, can be gap measurement rules, or managerial discretionary kind of choices, opportunistic choices. How do you think that using a disaggregated data set allows you to say, hey, my third test regarding consistency is more driven by opportunistic choices rather than whether the firm actually has certain type of a business transaction during the past 3 years? That part of the writing kind of confused me a little bit, because I think sometimes you test something using your reported numbers and then you say that is estimation error. Some other times can be related to choices, but there doesn't seem to be an identification strategy based on disaggregated items to actually disentangle all those different drivers. Do you get my question? Yeah.
Sort of. So
Yeah.
I think what Patty, Chad, and I were thinking is that, I mean, in general, this variation should be driven by gap rules. And hopefully this is going to get at your question. And so we would just, set these tests up, whether it be descriptive or the regressions, to say, like, does this map into what we think? We knew we were going to get the pushback and say, well, asset impairments have a lot of discretion. We would expect them to be less persistent because managers are perhaps manipulating those. So we wanted to put some sort of formal test to kind of address that. So we didn't test anything. Just part of this is because we kind of run out of space in a paper. And I don't know if this is what you're getting at, like tests that combine managerial incentives with reporting numbers with, maybe the reporting choices they made in prior periods. We don't have anything to say to that. And I don't know if I'm getting your question, answering it exactly. I mean, there was this, I mean, we have a lot of tables that we put together over time that never made it into our paper. And a lot of this because we don't have room for it. But the reporting consistency, we just came up with this objective way. Like, do you report it for 3 years in a row? Does this have different empirical properties? That's all we were sort of testing there and saying yes, and trying to say yes or no. So hopefully it sort of answers your question. But if not, kind of the general thing is like, we can only do so much in this paper, and hopefully, future researchers can tackle that.
I got that. Thank you. Yeah.
Okay. So how did we go about fleshing this out? Edgar's this great thing. It's pretty messy, but and all the credit to this goes to Chad. What Chad did, he was at University of Houston, bought him 4 desktop computers, so tower computers that he was able to set up in parallel. And in a nutshell, he used Python to go into the Edgar statements, the 10Ks, find the statement of cash flow, pull that out, and then basically use algorithms to try to reverse engineer the line items on the statement of cash flow. And so there's a lot of different algorithms or different types of coding techniques he used to do this. Ultimately, what we found though is the way it all works out is if we can uniquely sum up items in that portion of the statement of cash flow to equal FOPO in CompuStat, along with to reconcile the other items in CompuStat to the statement of cash flow, we felt comfortable that to say like, okay, these are the 4, 5, 8, 10 items that CompuStat added into FOPO. Okay, and I mean it's pretty fascinating. This slide up here shows 188,000 different FOPO line items across 68,000 firm years, 40,000 unique line item description. There's 1,800 unique ways that firms describe bad debt expense, provision for doubtful account. I mean, all these different things that you and I as accountants, we understand that. But it's fascinating, I think, nonetheless, to say like, holy crap, there's 1,800 different ways that this is set across 21 years. So anyways, this was done over the course of, I don't know, maybe it took many months, but to run this. But I think we were able to kind of get a good sample of sort of what comprises this FOPO data item. All right, so what do we find? So descriptively, we find this is maybe one of my favorite figures in the paper. So this is number of FOPO components reported over time. All right, so FOPOs existed in CompuStat since the 70s. Our data set obviously goes back to 1995. What this is showing is that solid dark line. This is the average number of FOPO items reported by firms. So 1995, I think it was around 1.9, 1.92. Okay, and there's variation in there, obviously, and we see in the 99th percentile in 1995, I think was a little over 5. It's gradually increased over time. Okay, and this is more than just, now we have stock-based compensation. And I think what's important, it's not just the average, which in 2016, I think was just under 4 items, but it's these extreme quintiles, these extreme percentiles. So in 2015, I think it's closer to 10. And if you go above that, sometimes it's there might be 15, 17 different items. Firms are reporting that if we just look at the CompuStat data, it's just collapsed into one variable. So all that unique variation that I showed with K-Force and Resolute Force products is being lost, all that unique variation, if in fact it's even included by the accounting researcher. Because remember, oftentimes people use balance sheet accruals, or people will use they'll use, Deshav do this. They don't even look at FOPO. So their accrual quality measure just looks at change in working capital accruals because they were interested in how accruals reverse. And that was their definition of quality. And so this FOPO item was excluded, and it's been excluded from other studies as well. So this seems to be an important item at least in terms of number. Now, in terms of economic significance, figure 2, what we're doing here is we're saying, all right, if we sum up the individual line items, the absolute value of the individual line items, how does that compare to the absolute value of FOPO? So sort of what this is fleshing out is how important are offsetting items within FOPO, the positive and negative add backs. Okay, and so the percentiles are sort of what's interesting. It's obviously not that surprising that at the lower percentiles, they equal each other. There's no difference. But over time and at the upper percentiles, these things can get quite large. And so the y-axis here is as a percentage of average assets, because that's the modal scaling variable in accrual research. And we can see that it's 2.5 to 3% of assets is sort of what you're seeing. And obviously above the 90th percentile, it's much higher. So what this is implying is that over time, not only are there more items being reported by firms that are being collapsed into that FOPO data item, but as archivalists, we can't we can't use any of this interesting cross-sectional variation because CompuStat collapses it into this aggregate variable. So the positive and negative elements just are, cancel each other out. And so what might look like that's 1% of assets, that could have a positive reconciling item of 8% of assets and a negative reconciling item of 7% of assets. Okay, and we don't, and so those are large accruals that firms are recognizing that are just offsetting when we look at the aggregate variable. So, I think this is sort of cool. This is just sort of, it's sort of a picture version of how important this variable is, to archivalists, or how potentially important it is. We've got other figures in here. Patty, Chad, and I like figures, and it's a matter of what can we show. So this is just kind of showing the composition of FOPO. We got 3A and 3B. This one's equal weighted. The evaluated one's the next one. And as you see, beginning around 2005, stock-based compensation represents about 50% of FOPO on an equal weighted basis. And perhaps that's not that surprising, right? Most firms now are compensating employees with stock-based compensation, so we see that. But at least before then, you don't see this big it's all comprised of write-downs, which maybe, some people might think. On a evaluated basis, it's slightly different. And what we see here is that, non-operating non-current accruals represent maybe the largest percentage. Okay, and that's very different than what we see. It's a different picture than what we see in on the equal weighted basis. So how do we reconcile these items? Well, every year, some large firms report large write-downs. Okay, on a economy-wide basis, this is important, and this is sort of what we think anecdotally from reading the Wall Street Journal and reading about these big write-downs. But archivally, if you think about on an equal weighted basis, these write-downs aren't quite as important, because most small firms don't have them, or if they do, they don't represent a large percentage. But on an economy-wide basis, they are sort of important. So I think, again, is there anything special with these two figures or these last four figures? Perhaps not, depending upon your view. But I think it's sort of cool because it kind of paints this picture that there's a lot of these accruals. We're missing them as researchers, and they seem like they could be important. And this should be something that we examine as researchers. Okay, I've got all the tables here. There's not a whole lot that's interesting here other than just we haven't yet mapped every single firm. And so there's little frictions we're running into that we need to work our way through. I think this is sort of the 80-20 rule, where 20% of the firms are going to take 80% of the time. So if you are ambitious and good at Python, contact us and maybe we can put you to work, or you can help out, help us parse some of this data. Descriptive stats, again, I don't think there's anything super surprising here. The one thing I would point out, if we look at FOPO here, notice the cross-sectional standard deviation is 8.1%. This is substantial. This is more than even working capital accrual. So there's a lot of cross-sectional variation here that can be used to describe economic events. So I think everything kind of maps to what we see in prior studies. All right, table 3. So this is a descriptive table. I think this is, at least I haven't spoken to Patty what her favorite table is. Now, this is how you know you're a nerdy researcher, if you actually have favorite tables. But I think this is definitely my favorite table, because I think it's just cool to see what this stuff looks like. Because we've all sat through workshops, especially dealing with earnings management, and we've got these stories of what's going on, but we don't know how large these accruals are. And so this is sort of what table 3 fleshes out. All right. Every year, what's the average standard deviation, and then the different percentiles. And then, we have AR1 slopes in there of the 32 items that comprise FOPO. Okay. And so we try to organize these in some semblance of the balance sheet, where we got, write-downs and with assets, and then we've got liabilities, shareholders' equity components. But one item I think is sort of instructive to look at. Here's AR provisions and allowances. Okay, so this is often thrown out as something that firms manipulate and manage. And so what we find, at least in our data, is across the 3,100 firms per year that we've mapped, little over 1,000 report a provision for doubtful accounts. So roughly 1/3. The average is around 0.8% of assets. Okay, so less than 1% of assets, and the cross-sectional volatility on that's 1.7%. Okay, so this is sort of speaking to the fact that, to the extent managers are manipulating this, because they can, only 1/3 of firms out there are reporting it because it's large enough for them to have to report. And the cross-sectional volatility of this is only 1.7%. Okay, so it's not 4 and 5% as maybe you would think, given what we've seen in prior studies. Warranties are sort of interesting. I think this is something I alluded to earlier. Only 18 firms per year are reporting a warranty expense in their that reconcile into FOPO. So to the extent people want to allude to the idea that managers are manipulating multiple things at the same time, it could be. But it's sort of neat to know, I think now, like, warranties don't seem to be what they're manipulating, because it's not even showing up as a reconciling item on the statement of cash flows. I think this is useful just to see as archivalists, because I think, you know, we've written in this area for the better part of 20, 25 years, and we've never really seen what this looks like in totality. And so this is sort of what this table 2 does. You know, and one thing I do want to point out is look at all these other categories. So it's toward the bottom, we have other gains and losses, other provisions, other charges, other you know, operating miscellaneous. These are sort of items that firms say. So firms might have every year, they've got an item called other. Well, what the heck is that? Well, we've got some tests that kind of flesh this out. Operating miscellaneous, this is our own created operating or other category, because as you can imagine, you know, there's a company out there that has a reconciling item called like BWA power charge. I don't even know what that is. They have it every year. We've got to lump it in somewhere, and so we had to create our own sort of miscellaneous category. But anyways, I mean, I think this is a pretty cool table. At least it kind of gives us some sense as researchers what's going on. All right.
So Bob, I just want to say thank you. In the piggyback on John, it's like,
Yes.
I think even for journal reviews, if one day I'm going to review a paper on textual analysis of bargain purchase, I think I can come back to your table 3 and say there are only 9 firms recognize it in the financial statement. How come you have 3,000 firms talking about bargain purchase, right? So thank you for also giving us a gift for journal reviews or conference reviews.
Yeah, I mean, I'm hopefully this will be useful, and yeah, I mean, we found it to be fascinating along multiple dimensions. So, you know, we were, whoops, sugar. I hit the wrong button, so now I'm gonna have to page down to get to where I was. All right, let's see, home. All right. All right, so of course we put regressions in there because that's what we do is archivalists, right? We've got to have some regressions in there. So tables 4 and 5, the gist behind these tables is just sort of these slopes right here. And I'm trying to, this FOPO G. So what we've done in the paper is we group the individual items into, you know, operating categories, and then 4B is going to do it into measurement rule categories. And what we should see is variation in the earnings persistence. You know, and this is sort of what we're seeing here. You know, the current operating ones are more persistent than the non-current ones. The financial FOPO accruals are the least persistent. These are the fair value accruals. Stock-based compensation seems to be the most persistent, you know, right? Or it's almost indistinguishable from that of cash flow. So we have different groupings in here. You could quibble with how we group them, that you'd be fair to do so, but kind of what we're trying to show is just the persistence differs based upon measurement rules. Okay. So this is basically how the paper unfolds. I've got about 5 minutes. I just want to jump ahead. We do this on an individual basis that you can see in the tables. There is some linear algebra in there when we try to rule out or kind of give some perspective on how important estimation error would need to be for our results to be explained by estimation error. So we build off a paper by Scott Richardson and Mark Solomon, Iram and Richard Sloan. We build off their general model, we modify it slightly. And this is sort of what we're doing in table 6, and sort of the gist of what we're trying to show is that, look, if you assume really large estimation error occurs, we cannot explain the empirical patterns we show. And so to speak to Young's earlier question, like Chad, Patty, and I would like to see the research sort of move this way. And I think this speaks to Ray's piece, or Ray Ball's point from his Horizons piece. If we are going to do earnings management, it'd be good if the researcher doesn't just say, hey, look, accruals are less persistent than cash flow. This is consistent with earnings management. But, you know, are the magnitudes of the slopes that you document, are they consistent with reasonable amounts of earnings management? And so that's sort of what we do with this model, is we try to quantify, like, is this even possible? All right, so I'm almost out of time. So I just kind of want to go to my concluding remarks to make sure I finish on time. So three takeaways, and I think this is hopefully comes out. The data. So I think this is what we think hopefully will be the most useful in kind of pushing the accrual literature forward. And I mean, this accrual literature is more than just the accrual anomaly. Remember, this factors into how we do cost of capital studies with earnings quality, factors into just general earnings quality studies, it factors into earnings smoothness, discretionary accruals. There's a lot of different elements that that are encompassed in accrual literature. And then even broader, financial literature as well. So hopefully this helps push the literature forward. And the advantage also being, like, it ties directly into the CompuStat variables that we're all used to. As I kind of went through quickly, we sort of extend the estimation error model of Richardson et al. And then Llewellyn and Resutek's 2019. The model's not fancy. It obviously can't control for all the economic and business dynamics that are accruals, but it does provide some structure to kind of think about this. And the big idea here is this idea of reversals. If there's estimation error with the accruals, there must be a reversal. And that's kind of shows up with this negative autocorrelation and accrual errors. This is something we need to be able to test for as archivalists. This is, the point that Richard's made in a couple of his recent papers, accrual reversals, negative autocorrelation. This is what we need to be testing for. So we think that this is a possible contribution, along with this idea of consistency. And so I think this consistency measure, it's not fancy. Basically we say a firm reports consistently if it reports the same item 3 years in a row. And so we believe that this will be useful. I mean, this could be useful in many different settings, but going back to that simple setting I set up, and we test this at the end of our paper, firms are going to have these accruals, these reconciling items called other. They have their own catch-all categories. Are the firms lumping in persistent items into that other category that are just too small to individually disclose in the financial statements, or are they more transitory impairments, more kind of the conditionally conservative accruals? By looking at this consistency characteristics, we as researchers could possibly get at some of these ideas. Stephen, I see you have a question.
Yeah, just one point on this reversals and persistence and so on. I think you'll be very careful the inferences you make from this.
Okay.
Someone mentioned this before. For the lifetime of a business, the total earnings is equal to total accruals, right? Total earnings are equal to total cash flows.
Yes.
So if accruals are higher now relative to cash flows, okay, they must be lower relative to cash flows in the future for a given company information set. That's sort of just built into the construction.
Mm-hmm.
If you're wrecking more now, you got to recognize less for a given set of cash flows. So I think you've got to be very, very careful to sort of lay out just when you're capturing this manipulation or whatever you want to call it, and what you're actually meaning by reversals and persistence to give a more economic meaning.
Right. Yeah, we can work on that writing a bit more. I mean, we're trying to get at this idea that the errors we're looking at is bad debt expense, not change in accounts receivable. So bad debt expense, if it's going to, I mean, if there's an error, you're too high this year, you have to, or you're too low this year, you're going to need to report more bad debt expense in the next year. That's kind of what we're trying to get at with these errors.
That's a good point. So focusing on those types of accruals, which now you've got the data to sort out to get at this, is going to be very helpful to sort out this, what is just by construction, okay, of how the accounting works, accrual accounting works, and what is actually has to do with the management or the underlying transactions or whatever.
Right. Yeah, so I mean, there definitely can be improvements in this model. This is just a simple structure. All right, So I've promised to plug next week's coming attraction. So next week, Daniel from University of Waterloo is going to be presenting, I think, a paper similar to this one, dealing with the standardization of CompuStat data and how that affects accounting-based return anomalies. You know, what we've documented using CompuStat data, how that compares to if you use as filed financial statement data. So looks like I'm good. I finished right at 12 o'clock, at least according to my clock. So thank you everyone for these comments. This has been great. Thank you, Stephen and Ayang, again for putting this conference together, this recurring thing. It's been awesome. So thank you.
Thank you, Bob.
Yeah. Sorry. Thank you so much, Bob. This is a great, very interesting paper. And also thanks again, Ayan and Stephen, for organizing this. Thanks everyone for joining this session. Hopefully to see you in the future sessions. Okay, so have a great day, everyone.
Bye.